A tax freight train is bearing down on your retirement. To protect yourself, you'll have to harness the power of zero.
Hello and welcome to the Power of Zero show. We're grateful that you're with us. This is David McKnight, your host. I'm the author of The Power of Zero, found on Amazon, or if you're buying in bulk, you can find them at thepowerofzerobook.com. Also the author of Look Before You LiRP, which discusses the different types of life insurance retirement plans out there and which I think are preferable if one desires to get to the 0% tax bracket. I'm also the author of the upcoming Volatility Buffer book, which is a novella in which I describe how the life insurance retirement plan can be used as a way to help maximize one's retirement income. So keep an eye out for that. Today, we're going to be talking about long-term care. We're going to talk about traditional long-term care insurance, and we're going to talk about why I believe that life insurance, in most cases, is probably the best way to handle long-term care needs in retirement. First of all, and this isn't going to be a long episode today, but I would like to touch on long-term care. What are the traditional misgivings with long-term care, and why I think there are better alternatives out there? For starters, why do financial gurus, at least, say that you need long-term care insurance? I mean, this is something that even Clark Howard and Dave Ramsey and Susie Orman agree that long-term care is a big deal, and that 70% of us will need long-term care at some point in our lives. Well, I think one of the big deals is that nobody wants to save money their whole life only to give all of it to a long-term care facility 2 years before you die. By the way, the average long-term care stay is 2.3 years. Typically happens the last 2.3 years of your life. You typically do not survive a long-term care event. It typically happens, like I said, the last 2.3 years of your life. They can last much longer than 2.3 years, or they can last shorter than 2.3 years. But I think that the idea behind long-term care insurance is that you don't want to blow through your entire net worth just prior to dying. That's one of the motivations for why people have long-term care insurance. The other one is what happens to a surviving spouse when one of the spouses needs long-term care. And I'll share with you a little bit of a dialogue that I have with my clients when I'm discussing long-term care with them. I'll say something along the lines of, "Mr. Jones, you know I love you, right?" And he'll say, "Yes, I know you love me." I'll say, "I do love you, but you're better off dying than needing long-term care." And he'll say, "Why is that?" And I'll say, "Well, at least if you died, Mrs. Jones would be beneficiary on all of your accounts, your 401k, your IRA, your home, your cars, they all go to her. And while we would miss you terribly, life from a financial perspective would go along relatively unchanged for Mrs. Jones." Okay. However, were you to not die but need long-term care, all of those accounts that would otherwise have gone to her now get earmarked to the long-term care facility. And your wife gets to keep one house, one car, about $120,000 of cash, and what we call a minimum monthly maintenance needs allowance. That's an MMNA, minimum monthly maintenance needs allowance, which varies from state to state, but averages out to be about $2,500 a month. You see, the federal government is not going to step in and pay for your long-term care unless you've really spent your assets down as a married couple down to about $120,000. And then it gets even worse if you're single, your spouse has predeceased you, then you've got to spend it down to $2,500 or so. You don't even get the house, the car, all that has to be sold off before the federal government, which is fair. The federal government doesn't want to pick up the tab if you have assets that could otherwise go to pay for it. After all, at the end of the day, all of these programs, including especially Medicaid, are massively underfunded. So the government is trying to find ways to make sure that they don't have to pay if they don't really have to. Now, by the way, what's the difference between a Medicaid-funded long-term care facility and a Medicare or a long-term care facility that you might pay for out of your own pocket? Well, this is sort of part of the plot line of my new book, Volatility Buffer, is that there is a massive difference in care between a Medicaid-funded facility and a privately funded facility. You are getting bare bones care. You are getting care that studies have shown will lead most likely to a premature death. In other words, you're not going to last as long in a Medicaid funded facility as you would in a privately funded long-term care facility. So it's a big deal. People want long-term care insurance. They want long-term care protection. They need it. Relying on the government to handle the last few years of your life is suboptimal at best. So people are trying to figure out how to grapple with this thing. And according to the Wall Street Journal, fewer and fewer people are using traditional long-term care insurance to cover this need. Why are they not using traditional long-term care insurance? Well, number one, it's expensive. For a couple, it could be $8,000 to $10,000 per year. So that's a big deal. There's no guarantees that it won't go up. In fact, those traditional long-term care insurance plans, the actuaries really missed the target in terms of pricing these things out. Initially, they underestimated what the casualty experience would be as a result of these plans. And so prices are really skyrocketing. So it starts high and there's no guarantee that it won't go higher. So that's a big deal. The third thing that is sort of a non-starter with these programs is these traditional long-term care policies are written based on morbidity, not on mortality. Morbidity is the likelihood that you'll need long-term care at some point in your life. Mortality is the likelihood that you're going to die. So let me put this into perspective for you. With traditional long-term care insurance, you could live to be 120. In fact, they may underwrite you and say, hey, this guy's going to live forever. However, if from a morbidity perspective, meaning maybe you've got rheumatoid or arthritis, or you've got a bad back or a bad hip or a bad knee, you may not even qualify, even though those conditions would not in any way curtail your life. So we've talked to clients that were otherwise in excellent health, but they had some arthritis in their hands or in their shoulder or what have you, and they just got flat out rejected for traditional long-term care insurance. And finally, I think the biggest source of heartburn for people when it comes to traditional long-term care insurance is it's a use it or lose it proposition. Nobody wants to pay for something for 30 years, die peacefully in their sleep, never having used it, and not get any of their money back in the end. So those, I think that's a pretty good summary as to why people are starting to cool to the traditional long-term care insurance. In fact, if you look at all of the sales are dropping precipitously, and sales for the type of program we're going to be discussing here shortly, at least according to Wall Street Journal, are starting to skyrocket, and I think there's good reason for it. So what are people doing instead of traditional long-term care insurance? Well, they're basically using some form of life insurance with either a long-term care rider or what we call a chronic illness rider. Now, let me before we get into how these work, let me just distinguish between a long-term care rider and a chronic illness rider. Basically, what happens with a long-term care rider is it's an additional charge. So if you think of a life insurance policy as a bucket of money, at least a permanent life insurance policy, or what I refer to as an LIRP or life insurance retirement plan, traditional life insurance or permanent life insurance is a bucket of money. Your premium goes into that bucket, can grow in a number of ways, can grow in the stock market, can grow in the general portfolio of an insurance company, can grow mirroring a stock market index with a cap and a floor. There's all sorts of different ways to grow your money. So the money goes in, it grows in some fashion, and money drips out of your bucket through a spigot. This is all symbolism, through a spigot, and that spigot goes to pay for traditionally annual renewable term insurance, some sort of life insurance protection. So that's traditionally how this works. When you have a long-term care rider, you are basically paying higher expenses. So basically, you're saying, I am going to pay more expense along the way for the privilege of using my death benefit in advance of my death for the purpose of paying for long-term care. In other words, let's say the life insurance company says that you're going to retire. You're going to die at age 90. Well, if they have to give you your death benefit before you die, then they're not going to get the benefit of those additional premiums. So they have to charge you along the way. So basically, the drops coming out of your bucket are going to be a little bit bigger. Now, that's can be a source of heartburn for people, because it's the same heartburn that they might feel with traditional long-term care insurance, which is this: you are paying for something that you hope you never have to use. In other words, should you die peaceful in your sleep 30 years from now, having paid all of those extra expenses for the long-term care rider, and then die peaceful in your sleep never having used it, you don't get that money back. You paid for something that you hope you never have to use. So that's the long-term care rider. The second way of dealing with this is through what we call a chronic illness rider. And the chronic illness rider gives you the same benefit. In other words, it allows you to receive your death benefit in advance of your death for the purpose of paying for long-term care, but you don't pay anything along the way. Okay, you don't pay anything along the way. Well, how's this good for the insurance company? How do they make it work? Basically, what they do is they say, okay, if we're going to give you your death benefit in advance of your death for the purpose of paying for long-term care, we're going to discount it. Let me give you an example. Let's say that your death benefit or your your chronic illness rider allows you to receive 2% of your death benefit per month over the course of 4 years. Let's say also that you have a $500,000 death benefit when you need to draw down that death benefit to pay for long-term care. Well, 2% of $500,000 is $10,000 per month. Okay, so that would be the chronic illness benefit. Before they let you keep that $10,000, they may discount that based on the age in which you receive the benefit. Some companies might discount you anywhere from 75 to 90% based on how old you are, based on the cash value at the time you draw the benefit. The reason why people tend to like this chronic illness rider approach over the long-term care rider approach is that you're not paying anything along the way. And should you die peaceful in your sleep, never having needed the long-term care, you didn't waste any money along the way. So there isn't that heartburn associated with having paid for something that you hope you never have to use. Now, what are the other benefits of life insurance? Well, we know that with traditional permanent life insurance or life insurance retirement plans, you can touch the cash within the bucket prior to 59.5 with no penalty. Not something you can do with IRAs or 401ks. You don't receive 1099s as your money grows, meaning that you don't receive that tax bill, which means your money grows more efficiently. And then when you take the money out, if you take it out the right way, you can take it out tax-free. When I say right way, you're typically withdrawing up to your basis because whatever you've put into the program, you've already paid taxes on, so you can get that back out tax-free. And then anything above and beyond your basis, you take out by way of a guaranteed 0% loan, which many companies now offer. There are also no contribution limits on how much you put into these permanent life insurance policies. There's no income limitation, so you could make $1 million a year. You could make no money, and you could still have the ability to put money into these programs. Whereas traditional tax-free alternatives like Roth IRAs do have limitations. If you make more than $199,000 in modified adjusted gross income, you can no longer do a Roth IRA. Or if you make no money, you cannot do a Roth IRA. None of those rules apply to traditional life insurance retirement plans. And then the last one I think is really important, and it's this: these permanent life insurance, or what we call life insurance retirement plans, may be immune from legislative risk. And the reason I say that is because historically, anytime they've changed the rules on these types of policies, they've simply said that in the event that somewhere down the road, we should essentially have said, if we were to change the rules on these, you will be grandfathered. In other words, you will be able to keep the bucket, continue to put money into it under the old rule for the rest of your life. So you're sort of immune to legislative risk through these types of grandfather clauses. So these long-term care benefits are all couched within this life insurance context. So you have a life insurance policy that has all of these benefits that are positive benefits, on top of which you have the ability to take care of all of your long-term care needs without the traditional heartburn associated with long-term care. So what we're finding, at least with our clients that are between 50 and 65, is that they are looking towards the LIRP, or this permanent life insurance, as a way to cover their long-term care bogey. Okay, they've long asked themselves, people that are between 50 and 65 are typically dealing with someone in their life, typically a parent, who is going through long-term care at that very moment in their lives. If you're between 50 and 65, there's a good chance that you're dealing with someone, a mother, a father, a stepmother, or a mother-in-law, father-in-law, that's going through long-term care. And you're asking yourself, how do I avoid the financial carnage associated with a long-term care event? Because it literally forces you to spend down all of your assets that you might have otherwise earmarked for your children or for a charity or what have you. So 50 to 65-year-old baby boomers are asking themselves, how am I going to deal with long-term care without having to resort to the painful alternative of traditional long-term care insurance? And so, according to the Wall Street Journal, more and more people are using a life insurance-based approach to long-term care simply because it doesn't have the heartburn associated with the traditional approach to long-term care. So that's our discussion for today about long-term care. Remember, there's two ways to approach it. You can have the long-term care rider, or you can have the chronic illness rider. The long-term care rider, you pay along the way, but you get that full benefit on the back end. So in that original example of $500,000, if you got 2% of the $500,000, you'd actually get to keep the full $10,000 monthly benefit. Whereas the chronic illness rider simply says you don't pay along the way, but you'll pay a discount on the back end, and that discount might be 75 to 90%, meaning they would discount that $10,000 monthly benefit anywhere from 25 to 10% based on your age and a couple of other factors that figure into it. So anyway, thanks for being on the show today. Remember, in the next few weeks, we've got my book, The Volatility Buffer, coming out. Another big deal, April 21st, our movie, The Power of Zero, The Tax Train is Coming, will be hitting Amazon and Hulu and Google and Microsoft, all of these other platforms. So you'll be able to stream it right onto your computer, right onto your TV. You'll also be able to buy DVDs and Blu-rays directly on Amazon and other outlets. So that's exciting, and that's coming up April 21st. Anyway, if you need to contact me, go to my website, davidmcknight.com, and we're happy to help you in any way we can. Thanks so much for being on the show today.